Per usual, everything else channels for educational purposes only, is not intended as financial advice. It is Teaching Tech Tuesday. I've been getting a bunch of questions about dollar cost averaging, DCA. So I thought I'd talk about that a little bit here, specifically for BTC, but also for alts. We'll take a look at ways we can do that on Kraken. For those unfamiliar, dollar cost averaging is buying at a specific interval where you are price agnostic. That is the baseline assumption. You're just buying every day, every week, every month, every quarter, every year, whatever it is. The opposite of dollar cost averaging would be lump sum buying, which can be price agnostic if you want, meaning every year I just buy some BTC and I'm done with it. Now, depending on the time frame that you're backtesting, because I'm sure I'm going to get that question, I have some charts on that as well. Depending on the time frame you're backtesting, you're going to get better results or worse results. But I think the most important thing is, like going to the gym once a day, at least you're going to the gym, right? At least you're getting money into the market. You're not always going to like your entries. You're not always going to like the price action. That's not what this is about. This is about over time looking at, for instance, Bitcoin profitable days. 98.7% of Bitcoin's history has been profitable. Are there going to be diminishing returns? Probably. Is this going to go up forever? Probably not. But based on history, based on what we've seen so far, and I've had these same videos and these same conversations with people for the past decade. Some of them have listened, most of them have not. This is why you dollar cost average, because this is a super volatile asset. And what DCA can help you do is get rid of and really ignore the volatility. You prefer a down market if you're dollar cost averaging. You want the bear market if you're dollar cost averaging. You want the time component to have the opportunity to buy lower prices. That's the goal here. So I'll also talk about some ways we can mitigate buying at the highs if you're not necessarily price agnostic and you want some sort of risk metric. But I'll put all the links for these articles in the description of the video. And like it says here, it's a way to spread out purchases over time. I think for most people, they are paycheck dollar cost averaging effectively. So every 2 weeks, they are DCAing into their retirement account and they're buying the S&P 500 or the NASDAQ or whatever, some target date fund. This is not different from that. This is the exact same thing. It's just a different asset. There are some websites that'll help you navigate this on the backtesting if you want to look at weekly, bi-weekly, semi-monthly, monthly, one-time purchase. In general, I think the math will tell you Mondays weekly is best. I've also got some math on some other stuff here. But in reality, it doesn't matter that much. Now, if you're trying to min-max some sort of entry on the dollar cost averaging, maybe there is a little bit of massaging you can do, but it really doesn't matter, right? Most of the time. Now, another way you can split this up is you can say, okay, 50% blind DCA every 2 weeks. And then based on the price action or price range at the time, I'm going to buy more if we go down. I'm going to buy less if we're sitting at the top of the range. That's just a basic thing we can do. We'll take a look at Bitcoin here in a second because I've been getting a lot of questions specifically for BTC in this range. There's also this website, the Nakamoto Portfolio, helps you compare some of the risk metrics, lump sum versus dollar cost averaging. And it's going to depend on time frame. Absolutely. But for a lot of people, lump sum buying is impossible because they're just paycheck DCAing, or it's just too painful to see that quick hit to any investment potentially. But you got to remember, this is the marshmallow test. This is the long game. This is watching something happen, not over the next couple days or months, but multiple years. And that's why you probably don't want to DCA something that doesn't have years worth of history to do this backtest and to look at the profitable days. If most of the history of Ethereum or page 56 coin isn't bullish, then it probably doesn't make sense to dollar cost average something unless you're super sure that it's going to return after a bear market. Before we go any further here, let me mention today's video sponsor, Kraken Pro. Kraken Pro is a complete overhaul of the Kraken trading experience with a one-stop shop for advanced and professional traders. Kraken Pro enables efficient trading execution across multiple markets with a UI that allows for unique optimization tailored to your trading style. You can check out Kraken Pro with a link in the description of this video. Not investment advice. Crypto trading involves risk of loss. Cryptocurrency services are provided to U.S. and U.S. territory customers by Paired Ventures, Inc., PBI, DBA, Kraken. On the old BTC real quick, not looking bullish. Sol similarly, look, I can only say it so many ways. Things below the cloud, not bullish. Anything that looks like this ever, forever, and always, doesn't matter what it is, with the head and shoulders like that, not bullish. Now, is it going to bounce 10,000% tomorrow? I don't know. But as we stand here, not bullish, and looking at BTC, still in the daily cloud there, breaking down on the ascending triangle support. Potentially the next stop would be 91. And after that, the 20-week moving average. If we turn on the 20-week moving average on the daily, that would be the 140 moving average on the daily. Then we can say, if we're talking about DCA versus lump sum, maybe we want a DCA closer to the 20-week moving average. Maybe we want to put a limit order on the 20-week moving average. Maybe we want to bump up the dollar cost averaging size-wise below the 20-week moving average. These are all things to consider if you want to make it slightly more difficult for yourself. When we are extended, when we are overbought based on the moving averages, based on the mean reversion criteria, then that usually is a worse time to DCA. That isn't to say things can't keep going. It's just basic mean reversion principles. The same was true for last year, all of 2024. We snaked in and around that 20-week moving average, settled down June to October below the 20-week moving average. You know, if you just want something super basic to gauge risk quickly and you're not a big fan of the cloud, you can do that. And it's an absolute bloodbath out there today in altcoin land. So in Kraken, this is the Kraken Pro interface. If you click the grid matrix up there and you move to Kraken, the retail side, on my little test account here, what you can do is click on an asset, click buy, and then on the order type, you can go to recurring and then choose if you want weekly, bi-weekly, monthly, if we wanted to start on a specific day, if we wanted to do a weekly starting on Monday, whatever we wanted to do. And then we can also do any asset that we want that's on Kraken here. You have to keep in mind on the retail side, the fees are going to be higher. This is effectively market orders versus limit orders. There is a cost here to doing the dollar cost averaging through the retail platform. So looking at some of this backtesting data, I haven't updated it through today, but historically, we can see all the options, yearly, monthly, quarterly, daily, whatever, weekly, it's all here. And oddly enough, what actually performed the best, at least in this time period, was mid-odd quarter. So what does that mean? That means first and third quarter, halfway through the quarter, that's when you dollar cost average in human time. That's basically a lump sum, right? Because you're not dollar cost averaging weekly or even monthly. You're doing it intra-quarterly odd quarter. So it's kind of a weird thing, but you can just pick a day on the calendar and say, okay, I'm going to start dollar cost averaging here or there. You can also think about the start of the quarter versus the end of the quarter, the start of the month versus the end of some month. And then looking at the weekly data, Monday tended to be the best day along with Sunday. Although if you asked me today what I thought but the best day to dollar cost average would be, to me, it would be Thursday, because I feel like Thursday, end of day, US time, 4 p.m., there's usually some sort of sell-off towards the end of the day. If we were to look at the backtesting pre and post ETF launch, I would bet there would be a difference there in the best time to DCA if you really wanted to min-max it. But in general, does it really matter? Does it really matter? Now, Thursday to Monday, maybe that matters more than just any random day, but it hasn't seemed to really matter in the grand scheme of things that much. It really doesn't matter that much, right? Relatively not that big of a deal. This was also another backtest on various scenarios: daily, weekly, monthly, quarterly, mid-quarter, odd quarter. And this backtest for this time frame was monthly, the first day of the month. So it just depends on which data you backtest this on. I would think pre and post ETF would be different. And I would also think post 2014 is where you want to be looking at the backtesting. But even just once a year, basically lump sum, was good enough. It was in the ballpark, right? So if you don't want to fiddle and fool around with daily or weekly, monthly or yearly, totally fine. Totally fine. No issues there based on the backtesting at that time. And then I just wanted to remind people of the meme coin portfolio DCA that we had discussed at this point months ago, last year. If I were to actually write this up percentage-wise, I don't think these coins would be doing so hot. They're all down pretty significantly after being up quite a bit. Some of these back to their November 2024 levels. So for a brief period of time, some of these did very well, and they may do well going forward. I don't know, but it's just one of the more obvious reasons why you're not probably going to do better dollar cost averaging something super high on the risk spectrum versus taking it easier on something that isn't going to disappear on you. Now, what you can do through Kraken is do some sort of like top 10 DCA, top 5 DCA that you could totally do on a spreadsheet. Just say, okay, I have X dollars per week. I want 25% in BTC, 10% in ETH, 15% in Solana, whatever it is, right? And then you just map it out like that. But that can be done through the Kraken interface. So I hope this is helpful. If you have any more questions on the dollar cost averaging strategies, let me know. And keep in mind, one easy thing you can just implement is a moving average on a high time frame. If we're above it, maybe you dollar cost average a little less. If we're below it, maybe you dollar cost average a little more. That way you can try to get more bang for your buck, even though you're going to have momentum on your side, price-wise, as price is moving up. That's all for this one. Like, dislike, comment, share, subscribe, and happy trading.